Capital flows have been busy chasing. How are you going to feed the OpenAI beast? $1.4 trillion of spending over the next 5 years, which flows down through the Googles and Microsofts. But if you look at all these agreements, they have to energize by a certain date or else forget it. And then when you look at the financing of these deals, these backstops are not with the parent. The SPV is the entity that has to take on all of the obligations. And so I think the economics of this business are still being created. And just like the internet boom in the late 90s, early 2000s, people think it's a capacity game when in reality it's not. This is no longer a business where it's all about hitting an exahash goal. It's really a question about controlling and owning lots of amounts of power. The ownership of electrons is key in this. If you sign up and you have a PPA at whatever, 8, 10, 12 cents, and you have land and you're going to build this site for a hyperscaler, you don't own the electrons. You simply have a contract to purchase electrons. If you believe that electrons are the new oil, then you want to own the oil well. As long as you are paying a PPA, you are a slave to an energy generator.
Welcome back to the Mining Pod, presented by CleanSpark, America's Bitcoin miner. On today's show, we are joined by Fred Thiel. He is the CEO and chairman of MARA, formerly known as Marathon Digital Holdings. The largest publicly listed Bitcoin miner by hash rate in North America, MARA has been one of the slower movers in the gold rush to AI and HPC infrastructure. While stocks like Iron and Cypher have seen tremendous re-rating due to their focus on servicing customers like Google, OpenAI, and CoreWeave, MARA has instead focused on Bitcoin mining and continued to grow out its portfolio of energy assets. That is until the Q3 earnings, where we saw MARA announce multiple initiatives to capture land in the digital gold rush for AI and HPC. We sat down with Fred to discuss its multiple moves into this market, what he terms as inference at the edge, including its deal with MPLX, a subsidiary of Marathon Petroleum, its deal with Exaion, a subsidiary of EDF in Europe, and of course, the current usage of its Bitcoin mining portfolio, using it as a bridge gap in order to move into AI HPC. We had a great podcast, 60 minutes long. Stay tuned, stay put.
Guys, there is a serious problem right now in Bitcoin mining, and we need to talk about it. You need to pay attention to this. Bitcoin miners are identifying as AI companies, and people keep missectoring them because they say, well look, your infrastructure is clearly for Bitcoin mining. What do you want me to do about it? I'm going to tell you what you need to do. You need to call FBox, the leading digital infrastructure company with all-encompassing cooling solutions. FBox designs industry-leading air, hydro, and immersion cooling systems for Bitcoin mining and AI and HPC data centers. I want to highlight that. If you're a Bitcoin miner who needs to bridge the gap, if you're pivoting or doing hybrid operations, they can build cooling solutions and infrastructure for both your Bitcoin mining and your AI and HPC operations. And they have an in-house API that lets you monitor it from the web or on mobile. So go to www.fbox.tech/contact to learn how FBox can help you optimize your digital infrastructure today.
Hey, welcome back to the Mining Pod. We have a guest on today that we haven't had on 2-3 years, I think, at this point, Fred. So it's good to have you back on the show. Appreciate your time this morning.
Great to be here.
Yeah, I think the last time we chatted was at the Wyoming Jackson Hole Symposium every year for Bitcoin mining. We sat down in the bottom of like a ski lodge, and you talked about enduro. Yeah, it was a really fun conversation. And you predicted a lot of things before they happened. So you started talking about Bitcoin sidechains, how important they've become, and within the next year or two, a bunch of those projects popped up, including what Mara's worked on. So it's just kind of fun to like reminisce back on that. And yeah, always a fond memory for me. So appreciate your time on the show today. For today, we're mostly going to go through the Q3 earnings call and then also just talk broadly around strategy as always. So I just wanted to kick it off and kind of give you a few moments to kind of talk about what you reflected on from Q3 and from the year that has been so far from Mara's standpoint. And then I'll dive into a bunch of specifics and we'll kind of turn over every log and stone.
Yeah, I mean, I think, a key thing as you look at 2025 kind of broadly writ, it's been a year of transition for the industry. We have been for, most of this year, and I think starting late last year, been talking really about inference at the edge, compute at the edge as being kind of where the world is going. Granted, capital flows have been busy chasing how are you going to feed the OpenAI beast? $1.4 trillion of spending, self-proclaimed. over the next 5 years, which flows down through the Googles and Microsofts, et cetera, of about $900 billion. And then goodness gracious, where are we going to get all this capacity? And, contracts are being written. And I think it's interesting. I think it was either the end of last year or early this year, I made the comment regarding Core and the CoreWeave merger that I said, the industry's got to be careful because a lot of these contracts have outs regarding delivery dates. The folks at CoreWeave weren't very happy about that comment and sent us kind of a cease and desist, or it was maybe Core who sent the cease and desist, telling us not to be saying those things. But if you look at all these agreements, look at some of the recent, I don't know if it's the IRIN or the Cipher agreement, but they have to energize by a certain date or else forget it. And then when you look at the financing of these deals, these backstops are not with the parent, it's not with like Meta. The SPV is the entity that has to take on all of the obligations. And it's only the hosting agreement post expiration of the hosting contract that Meta or Google or whoever is backstopping. So, I think the analyst community, as I said on our Q3 earnings call, has to do a much better job of really pulling these things apart. And I think that what we're going to see is we're going to quickly get to a point where these projects won't necessarily all be delivered on time and demand won't necessarily be there. Because you have on the other side of this, major corporations are looking at the spending and saying, I'm not going to leave this stuff in the big public cloud. I'm going to run this in private cloud. And we've been spending a lot of time, as I said on our Q3 earnings call, with analysts, the Gartners of the world, not the financial analysts, and the enterprise customers. And they're saying, oh yeah, it cost me 10 times more to run models in the cloud than in private cloud. We are pulling this in. We are going to be using open source models. We're going to be doing stuff very differently. And so I think the economics of this business are still being created. And just like the internet boom in the late 90s, early 2000s, people think it's a capacity game when in reality it's not. And you've even seen the comments that OpenAI's CFO made, correct or not, that basically, hey, this is of such a strategic importance that the government should backstop us, starts calling into question the whole kind of model. And then you look at technology obsolescence and all that. But so as I look back across the year, I think we have been very carefully focused on a couple of things. One is acquiring as much power as we can. This is no longer a business where it's all about, hitting an exahash goal. It's really a question about controlling and owning lots of amounts of power. And as you saw with the deal we announced regarding MPLX, it's about having access not just to power, but it's actually owning the power. And so power, all of a sudden, electrons are a very valuable thing to have. And whether you're talking to people internationally in Saudi, in France, Germany, Africa, Latin America, US, it's owning the electrons, which is critical, because then you have the optionality to choose what you want to do with them, right? And for us, this is a very critical piece of the strategy. If we own the electrons, then we can decide what we want to do with them. And we can use them for a mix of things. We can mine Bitcoin to initially monetize the electrons, add HPC, AI, or inference, et cetera, and then have the flexibility of operating. Another thing we've been very focused on is actually, can you do inference in modular technologies? Can you avoid having to build these big buildings? And again, in Q3, we announced for the first time, we're now running inference AI in a traditional mining container-sized modular solution. So again, proving out the thesis. And so we're moving very methodically along. We realize that, a lot of people wish we were announcing big HPC deals. We're purposely not. We're very focused on executing a plan. We made the Exaion investment announcement, and that's still going through its regulatory processes. But that essentially gets us to a place where we have the core orchestration technologies and the core technologies in the data center, as well as the core competency in design and building tier 3 and tier 4 data centers, such that we now have the optionality of leveraging our power, the control of electrons, in lots of different ways. The other thing we've been very methodical about this year, and it started late last year, and we will hopefully start seeing more public information about it before the end of the year. Our relationships with major global energy companies that continue to essentially build on what I initially said that I think it was Mining Disrupt 2021, that you either have to be an energy company or you have to be partnered with the energy company, or the energy companies will take over your business. Well, I think that is going to play out, especially outside the US, because energy is a strategic asset. And when I spend my time traveling internationally, talking with government leaders in different countries, energy is a national security and strategic resource. And so if you can partner with the governments, you're in a much different position than if you're just trying to get a PPA somewhere and tie up some land. Because the government decides whether you can operate. The government decides whether they're going to let enterprise customers use your cloud, whether your cloud will be deemed sovereign or not. These are things a lot of companies don't think about. So you can kind of think of this year as this is our transition year, where we've gone from just chasing exahash to being very methodical. The other thing we've been very focused on is our hash cost. Our hash cost per petahash per day, if you go through the latest financials, you'll see they're about $31, and our hash revenues are about 53. So we are quite profitable in our mining efforts today. As you look over time, that will continue to be driven down, especially with our control of energy.
Yeah.
The MPLX deal gives us initially 400 megawatts across likely 3 sites, with capacity to grow to 1.5 gigawatts. And those are 3 locations. And while that doesn't come on stream this year or next year, it's a 2027 initiative. Again, longer term, it's who controls the lowest cost of token in this business, because AI is all going to be about time, time to response, the latency, in other words, and then cost per token. And that is what's going to drive profitability in this business. And then when you layer on top of that sovereign cloud, private cloud, air-gapped, the ability to essentially, for the end customer to have full control over their data and their models, that's going to become the critical reasons why somebody chooses to partner with somebody or not. And so as you look at our business longer term, it starts becoming this combination of infrastructure plus SaaS. And I think that will generate long-term, some very attractive long-term recurring revenues and margins.
Love it.
So that's kind of the vision in a nutshell.
Yeah, no, that was fantastic. Thanks for kind of laying it out. And I think I'll pull on a few strings here, so we can keep the conversation going a few different ways. Let's focus on the inference at the edge. You've been using this phrase, I'd say, since I heard it as early as August. Maybe you've used it earlier. And I'm curious, what does that mean on a practical standpoint? I've talked to Bitcoin miners going back as far as, say, 2022, who talked about using some of their modular systems for AI HPC. At that time, it was more actually on like the rendering side. That was a big conversation for like, what are we going to use these GPUs for after the ETH merge? And so there was people talking about like, hey, let's throw a few megawatts up near a city like Dallas or New York, and then we can be that kind of last leg in the case that everyone really wants to watch Netflix that night. And so that was kind of the vision then. And now I think what you're sort of speaking about, and maybe I'll put in layman's terms for listeners, is there's going to be this need for private companies or cities or nation states to be able to throw up a few megawatts, run a GPU cluster with some sort of LLM model on top of that, and not be using OpenAI and not be using Google. Is that sort of the vision you're going through with the inference at the edge?
Yeah, that's
approximate or
a great way of kind of simplifying it.
Okay.
I think in reality, it's not GPUs, it's ASICs, because we're already there. What we're running at our site in Texas are ASICs, it's not GPU technology. OpenAI's business model is really driven based on people using their APIs.
Yeah.
Right. So I have stuff, I need my models to interact with their model. And that's hugely expensive. And you can already, whether it's DeepSeek or whether it's other models, which are all becoming more and more open sourced, you want to train those on your data. You want to build models specific to your use. You're going to do agentic technology using that. And an analysis we did was in talking to enterprises, we found that 70% of corporate data sits still behind the corporate firewall and is not in the public cloud. Right? Yes, there's email. Yes, there's Google Docs, et cetera. But the important data sits behind the corporate firewall, and that's not going to leave the corporate firewall. So how do you run inference? How do you build AI models there? Well, for one thing, you want to have it either running in a section of your own data centers, or you want to have it running in near proximity to your data centers, because you want latency to be low, ideally. But some of it, you don't care about the latency, right? So this is why you have to think about it. What are you using the AI for? So I'll give you an example. What do you think the vast majority of token consumption comes from? What do you think drives token consumption in AI today?
It seems to be search is the main use case I can think of, but
no, it's diffusion models.
Okay.
It's video, it's image creation.
Yeah.
It costs tens to hundreds of millions of tokens to generate an image. Right? A quick query in OpenAI is just a handful of, a couple hundred, maybe 1,000 tokens, depending on the complexity of the query and how much data you're feeding into it and all that. But if you talk to the folks who are actually looking at token usage, the vast majority of token usage today is image creation, because that's the most complex thing. And diffusion models don't necessarily need to operate in GPU clusters, right? So there's a different architecture. So what you're starting to see now is this fragmentation already within the industry.
Yeah.
And so there will likely be a world where you are using a control plane. So think of it as an interface where you have a variety of models that have a variety of needs. Some are low latency trading type, decision support, stuff that's real time in nature, mission critical. And then you have some things that are huge token hogs, but real deep research analysis where you don't need the answer in 5 minutes. You're fine getting the answer in half an hour or maybe even later today. And so what you start having is this layering of AI data centers where you have some stuff runs near prem, on-prem, some stuff runs in the metro area, and some stuff runs in the back 40 acres of a data center in Texas.
Yeah.
And so a couple of things. Who owns that control plane determines who gets the tokens, whose tokens are being consumed. That's a piece of business we're very focused on, which is orchestration. Having these different layers becomes very critical because then you can provide that, especially if you can ensure that the data as it transits these various data centers is never at risk of being exposed. So what does that mean? Well, it means your ability to store and transport data in encrypted form such that it can be used, and then the response encrypted and transported back again with full sovereignty is critical. And again, different set of technologies. So our perspective is this is not about bare metal GPU farms and AI factories, right? Yeah, that is a great business for some people to be in. We're looking longer term. How do we build a strategic relationship with customers so we're capturing the maximum value and the differentiated value? Because think about it today. When you interface with OpenAI, for example, you're replacing some stuff you used to do with Google. Yeah. And now OpenAI is disintermediating Google, right? And so you don't really care what OpenAI is running behind, where the data is housed, where it's being served and all that. You're just worried about the user experience, right? And I think the same thing is going to happen across the board here. And then enterprises are much more focused today on security because of the risk of quantum, because of the risk of cybersecurity. They are really, really retentive about security. Yeah. And so you are going to have to be able to prove that your data center is absolutely secure from a perspective of that data. And I think those are all things that a lot of our peers in this industry aren't even thinking about today. They're thinking about, how do I tie up power? How do I tie up land? How do I tie up a hyperscaler who's going to lease that from me? And I'll let them worry about all that stuff.
So go ahead.
Go ahead. Sorry. No, I could go on for hours on this, but just go ahead.
Yeah, no. Putting a few pieces together that you've talked about during this conversation, and obviously your earnings call and other things, I'm sort of seeing like a thesis being that for now it's about adding energy to the portfolio, monetizing that with Bitcoin mining, and then rolling that into a future state where the thesis is that there's going to be this need for sovereign cloud. The strategy against that, which we're seeing from some of the peer miners, is again, tie up energy, use Bitcoin mining for now as a gap, stop, you kind of fill in between, and then go sign a hyperscaler deal or go find someone who can be a co-location tenant. My question is, like, if I was to give you two slips of paper with different options for the future of the company that's going to be in terms of value from 5 years from now, one's like a hyperscaler tenant and one's the sovereign cloud. It seems like you would take option 2 with the sovereign cloud because you see that as more accretive to shareholders over the course of 5 years. What's sort of the math behind that? It's mostly what I'm curious about, because you've mentioned a few things. 70% of data is behind the corporate wall. You guys want to service that. There's many nation states. Obviously, there's 200 countries that might have an interest in booting up some of these things. But from a numbers perspective, I'm curious about this because we do have a lot of the numbers on the hyperscaler side. We kind of know that's like $11 to $15 million per megawatt, and then there's like a nice multiple on those things. So from the sovereign cloud side, what sort of finances are you guys looking at or numbers that you're pulling on to make this thesis?
So for one thing, the capital expense is lower relative to the compute.
Okay.
Because more of the revenue is attributed to orchestration and the full solution, right? So as opposed to selling infrastructure, you're selling solutions. So two things. There is the sales cycle is you're not selling to a major hyperscaler. You are selling to hundreds and potentially thousands of enterprise customers. That doesn't mean you're not also partnering with hyperscalers in providing software solutions around orchestration, et cetera, to some of them, right? And so what ends up happening is the return on your CapEx becomes much higher, but it ramps at a slower rate. But you avoid customer concentration. And I'll give you a simple example. So you sign a $6 billion deal with a hyperscaler over 15 years, right? Okay. What is the technology obsolescence on the hardware you're putting in there?
It goes pretty quick, yeah.
Right. So they're now saying 5 years. I think it's going to be closer to 3 years.
Mm-hmm.
So let's just say 5 years. That means you are going to do a full refresh at least twice, if not 3 times. Now, you're allocating for that $6 billion contract, $4-point-something billion of CapEx spending. There's no refresh in that $4.8 billion number.
Mm-hmm.
And so I personally think that, people are missing the mark here when they look at, Google, Meta, whomever will contract to use this capacity. But eventually this capacity is going to have to be, refitted to be competitive, or they won't. And then, so that's why I say, I think people really need to start looking at these agreements and really understanding the risks that the hosting party provides. Because if you look at the concentric rings that these data center strategies are built on by people at Microsoft and Google, the core stuff is going to run in their owned and operated data centers. It's the excess capacity that they're running with third parties because they need to have the capacity available. Whether they use it or not is a separate story over time and over what degradation of time.
Gotcha.
And so I think, you are essentially going to be a real estate developer in that business. You can't look at it as you're no longer a tech company. You're a real estate developer, right? You're going to tie up land, you're going to tie up power, you're going to offer it up to a hyperscaler, And then you're going to hope to God you can build this thing in time so that it energizes, so you don't have penalties to pay and they don't cancel on you at the last minute, right? That is a much riskier business, much bigger amounts of capital you have to raise.
Yeah.
And yeah, you're supposedly raising it through third-party financing, but that may change as the market goes on. So we believe that we've chosen a path where we become a technology solution. The ownership of electrons is key in this forever. And the great thing about when you own electrons, you actually own them. If you sign up and you have a PPA and at whatever 8, 10, 12 cents, and you have land and you're going to build this site for a hyperscaler, you don't own the electrons. You simply have a contract to purchase electrons.
Yeah.
If you are actually generating electrons, for one thing, your cost is a lot lower. That generation is third-party financeable. That asset may live 30 to 50 years. So it's a long-lived asset that you can use for then financing the balance of the business. And more importantly, you can optimize energy assets across a mix of Bitcoin, HPC, co-location, AI, SaaS, et cetera. They don't have to be sole purpose. And so now you have an ability to continue to monetize a site regardless of what's happening in the industry with the ebbs and flows of hyperscaler or other things. And if you're doing that more and more yourself, I think it gives you a lot more certainty and a lot more flexibility long term. Because what I can promise you is we don't know what 5 years out is going to look like.
Yeah.
Go back 5 years and look at today. From here to 5 years, we don't know how that's going to look. And I think you need to be agile to be resilient.
We are CleanSpark, America's Bitcoin miner, a publicly traded company with the largest operating hash rate, powered entirely by self-operated infrastructure across 4 states. This is our proof of work. We are setting the standard for what's next. Learn more about the intersection of energy and Bitcoin at CleanSpark.com.
Pivoting away from the strategy side of things, I want to go through some, not necessarily like line items, but some more specifics around Mara. And maybe I'll start with the mining side of things. So some of the analytics we ran is like hash cost, hash price. They're getting pretty close to each other, especially with hash price itself going down the last few weeks, right? Bitcoin has gone down, run down 100K. I think hash price is getting towards like $43 per petahash. Meanwhile, hash cost from Mara has gone up with SG&A last period. So Q3 2024 was around 35 million, and this period was around 45 million. Is that due to the increase in deployment of hash rate, or what are some other things that you're looking at when you're looking at SG&A from a top level and being like, this is the reason for the increases in those line items?
Well, so SG&A for us goes across all of our business segments, right? Which is, in our case, we consider mining part of digital energy. Part of digital energy is acquiring, operating, and managing energy assets, right? We own a wind farm. We're doing flare. So we're not lean and mean like some miners, because we have SG&A we need to allocate to what we're building on the Inference AI side. We have SG&A that we have to allocate to what we're doing on the digital asset management trading site. We have $7 billion of Bitcoin that we have to manage actively. And we have built the team to be able to execute the strategy. And so there's a lot of spending that goes on the front end of that. So I think it's hard to compare Mara to just a pure play miner who's being very focused on, operating a number of sites and just generating cash flow from that. We're trying to build something much bigger, where the sum of the assets is much more valuable. Because you can think of it this way: most miners today aren't being valued appropriately for their businesses, while some are being overvalued. It's really interesting. You can look at how the market views us, and essentially we're valued at the value of our Bitcoin stack.
Yeah, what does that say versus like the market's just misunderstanding this, and that's why it's important to go on roadshows and talk to different sovereign nations about this opportunity with Mara? Walk that out a little bit more for me, because I'm curious what you're thinking there.
Yeah, I think when we talk to people, it's very much that, if they want to have exposure to a Bitcoin miner, they can buy MicroStrategy, because at the end of the day, why do you own a Bitcoin miner? Well, it's because in theory, they can acquire Bitcoin at a lower cost than market. Well, the digital, asset treasury companies are soon going to be trading below NAV. So you can acquire Bitcoin at a lower price. And there has been an excellent trade around, shorting MicroStrategy, the Jim Chanos, right? Short MicroStrategy, go long Bitcoin, stuff like that. So the Bitcoin miners are purely viewed as an arbitrage tool today.
Gotcha.
And so I think it's what you need to look at. The market views us as this very volatile asset or equity, where you have certain correlation to Bitcoin, certain correlation to equity markets, and there's enough volatility so that you can trade around that, right? And it was really interesting. The miners, before the availability of the ETPs, ETFs, and before strategy or MicroStrategy really got going, the miners were kind of the only volatility play you could play and juxtapose Bitcoin, right? Then you saw a lot of volume move to MicroStrategy all of a sudden, right?
Mm-hmm.
And that became the play. And then with the ETP, ETFs, you now had a different way of holding Bitcoin also.
Yeah.
And so I think what you're going to continue to see is longer term kind of decreased volatility in Bitcoin, decreased volatility around the miners. The digital asset companies are going to consolidate around just a handful, maybe strategy and a handful of others who survive. And then you're going to start seeing now perpetual options trading on the, or perpetual futures rather, trading on the CME around Bitcoin. You're going to start seeing leverage on the CME. The markets are going to continue to grow. And as the banks start supporting more financial services around Bitcoin, the asset's going to mature and volatility is going to start narrowing. And then all of a sudden, it's a question of Bitcoin mining needs to become a transaction processor. And you're going to come down to who has the lowest cost of power, because it's the people in the bottom quartile who are going to survive long term and the other people won't. So, where I'm concerned for the industry's perspective is you have these companies that are out there acquiring huge amounts of hash rate in a hosted model. The hardware vendors acquiring as much hash rate as they can, or deploying as much hash rate as they can in a hosted model.
Yeah.
And so now you have some potentially, if you look at hash cost or hash price being down sub, 5 cents, it starts becoming challenging for some of those players to survive. And what happens when you start seeing those blowups?
Yeah.
Over time, because global hash rate's growing, it's not shrinking.
Yeah.
Right? As our peers are transitioning, it's not shrinking, it's growing. So somebody, whether it's Tether or whomever, is obviously putting on a huge amount of hash rate.
Yeah. Yeah. I think it's Russia, I think it's China, I think it's Tether, probably a few other nation states in there as well. Just to jump on another point you made. So if Mara is being valued by the market, or mining stocks in general, by the amount of Bitcoin they have on the balance sheet, would you say that going forward, the value creation for Mara itself and for investors is this inference on the edge, or is this ability to monetize those megawatts? And so is everything kind of here on out the ability to execute on that by signing new energy deals and then signing these inference deals? And that's sort of the future value accretion for the company.
Yeah, you can think of it as our North Star guiding our decision making is maximizing the profits we generate per megawatt hour of energy that we consume.
Okay, that's helpful.
And then as we acquire more megawatts, how do we monetize those, right? So if we have, to give you an example, let's say I have 500 megawatts of generation capacity or 500 megawatts of power that I control. I could take 200 megawatts of that, use it for Mara, and I could take 300 megawatts and sell that energy and do a traditional hyperscaler deal if I want. I have that optionality, and that optionality is worth something.
Gotcha. So on the Bitcoin mining side, relating this point, so Mara has, I believe, I got to look at the miner mag this morning and recheck the numbers, but over 60 exahash on the operational deployment side. But then in terms of actually operating, it bounces month over month, and then of course Mara pool numbers can kind of make that like a little confusing. But it's typically around like 75 to 80% of that hash rate on a rack is actually deployed. Is that discrepancy between the two things just because you guys are actively plugging things in and we expect that exahash number to get closer to like 100% efficient use of that hash rate? Or is it just because you guys are more focused on signing energy at this point and juicing every single ounce of Bitcoin mining doesn't matter as much?
So here's a change in perception I think people need to do. You have to look at how many megawatt hours you operate and how much hash rate you operate in those megawatt hours, as opposed to just assuming, like you're doing right now, that if I have an exahash, it's going to run 99.9% uptime. So when I have hash rate running at a wind farm that we own at near zero cost energy, it's not going to run 99.9% of the time. And so what we are very focused on doing is trying to get people to understand that we're going to start communicating in megawatt hour terms, not exahash hour terms. Right?
Okay.
So that you can actually, disconnect the amount of miners you own versus how many hours they're actually operating and what is their profit per hour and revenue per hour. Because the fallacy is, you have 10 exahash and X amount of power. Well, you're obviously not running them other than 80% of the times. There must be a problem, right? And that's not the case, right? So,
okay, that's good to know. Yeah, just for fact checking my own numbers, Miner Mag has of July, which I think this is obviously fairly outdated as it's November, but you had 43 exahash. Then I believe it's over 60 exahash now. And then as of July, it was 75% realized rate. Again, it's November now, so those numbers are a little bit outdated, but it's good to see that point on those things. I'm curious about the asset light versus the hosting. It'll be kind of my last mining question, and I want to pivot into some of the new things you guys talked about in the Q3. Yeah. Breaking down some of the numbers we did on our side and the hosting versus owned assets. If you sort of back out some of the numbers from the 10Q, you see very similar margins as of now from assets that Mara wholly owns and is utilizing mostly through Bitcoin mining at this point. And then the hosted assets that are, you guys are a third party at another facility and mining Bitcoin there, essentially mining Bitcoin. The numbers are pretty similar. How do you guys sort of think about those two things in a long-term perspective? I'll add some context there. Go ahead.
Yeah, the numbers, what I would recommend you do is sit down with our team because the numbers aren't similar, actually. There's a huge difference between owned and operated. And it's also depending on what you throw in there, what number you throw in. The pure energy cost is very similar in some cases. However, we are today only really hosted in 3 locations, right? We have a location in Texas, and then we have 2 locations in Texas, 1 in North Dakota. And those contracts will roll off in the not too distant future, at which point that hash rate will operate in more owned and operated, will be close to 100% owned and operated.
Okay.
The other thing I think what you'll see going forward are more arrangements with energy companies that are joint venture related. So, which will be a different model again. So, the way we're trying to get people to view things is, look at how many megawatt hours we're actually using, look at the revenue and profits per megawatt hour that we're using from a cash flow EBITDA basis.
That makes sense with a blended model.
It's a non-GAAP metric. We're not going to specifically call it out in the filings, but we'll footnote it and say this is a way to look at it. But I think that's the way the whole industry should be viewed, because especially as you get into these hybrid sites where you've got some HPC, some Bitcoin mining, and by the way, Bitcoin mining plays an important role in helping load balance for the grid, HPC sites, and making them more attractive to the grid operators. You're going to have to look at profit per megawatt hour realized.
So when you guys are looking at the international scene for signing new data centers, I'm assuming that the asset heavy model is going to be a continued sort of thesis for you guys. The last quarterly earnings, you guys mentioned that you want to drastically expand your international footprint. And as of now, you guys are more or less completely from a megawatt perspective in the United States. Like, yes, there's many programs in multiple countries, from Scandinavia all the way to South America. You guys have a pretty large footprint, but from a megawatt concentration perspective, it's mostly in North America. And so going forward, you guys intend to use some of those subsidiaries that you have in France and the UAE, I believe, in order to purchase hard assets in those jurisdictions. What are some of the additional costs investors or others can expect for operating those jurisdictions and having to acquire energy assets? Is there any considerations you guys have to go through in order to purchase those? Obviously, here in the United States, there's pretty free market around these things, but a headline recently has been like Chinese nationals purchasing energy assets has come under scrutiny. Can Mara investors expect Mara to have to kind of go through some of those jumps and hurdles in order to secure megawatts in different countries?
So I think in going back to what I said earlier,
yeah,
most of those types of deals will be structured as joint ventures with the energy company. So we don't need to own the energy asset. We are partnered with the energy company.
Okay.
And so when you're partnered with an energy company, you have it's a very different economic model. You don't actually need to own the underlying asset because your partner is contributing that asset to a joint venture. And so you don't have the issues of sovereignty, et cetera, that are at risk. And then, you're a partner with that person. So, we've been saying, I think for almost 2 years now that, 50% of our revenues should come from non-US sources by the end of 2028. And that's what we're very focused on doing.
Gotcha. So I think it's a great time to pick up the Exaion deal and talk about how that is going to be meaningful for Mara investors going forward. One thing we don't have a lot of is like the revenue cash flow expectations from that. And it's a private company, so kind of makes sense. But I'm curious if you can speak more to what that is going to mean for Mara's bottom line going to 2026, expecting this to get approval from French political authorities and that everything goes through. What does this look like? What does Mara look like having a stake in this joint venture, say in 1 to 2 years? I understand some of these things you can't speak to too much degree because it's private, hasn't closed yet, all those things. But I am curious if you can kind of walk out the roadmap a little bit more.
Exaion is today, a captive entity within the EDF, which is the largest electrical producer in the world, and is a company owned 100% by the French government. We are an investor in that company if and when everything is approved, and we believe it will be. And what that gives us access to is the ability to leverage some of the technologies that Exaion has and help bring those to market. And we will remain in partnership with EDF over the years, and we're looking forward to that long-term relationship. It gives us a couple of things. One is an existing large enterprise customer that's already using these services. And to be fair, Exaion isn't an owner-operator of large data centers. They are the operator of the data centers, and it's their technology that runs the data center. So remember what I said about orchestration layer. Remember what I said about everything that separates you from the control plane. Everything that makes what's running behind the scenes invisible to the user. That's what Exaion does. And so Exaion is really a software and technology company. It is not a data center company.
Okay.
And so don't expect huge revenue numbers in the short term because it is a technology company. It is the company that has developed a lot of the core technology that runs EDF's data centers. That is very exciting and interesting technology for other people. And so part of what we're doing is building data center assets that will wrap Exaion technology around and bring to market, as well as bring Exaion technology to other people running data centers. And so I think 2026, very modest numbers, but 2027 and beyond, the numbers should grow very nicely.
And would the expectation be that it rolls out throughout Europe, rolls out throughout France? I mean, I'm sure there's plenty of companies that could be using this in France, but is this going to be the main Mara play for inference at the edge? Is using the existing data center technology or the orchestration technology and then rolling it out across corporations and nation states? We can kind of expect that to sort of be like the entity or the basket under Mara that is pushing this inference at the edge on a practical level? Or do you expect to have other components that Mara is going to do in-house, separate from Exaion, perhaps even here in the United States?
Yeah, I mean, it'll be a complementary relationship. So Exaion will definitely be leading the charge internationally, based on what they already have today. Mara has been working in the background on a number of very complementary technologies, and it's the marriage of those two. The go-to-market will likely predominantly be done under the Exaion brand. Very much a Europe first, France first, Europe first, Middle East. Think of it as all of the non-US areas.
Yeah.
With Mara bringing all that stateside and bringing that into the North American market. And one of the key reasons why Exaion is very excited about the relationship with Mara is our ability to do a couple of things. One is help finance growth. The other is help commercialize their technology and products and bring them to the international scale.
Gotcha. Okay, that makes more sense. So let's pivot to the MPLX deal, and then I'll close out with a few final questions. Not quite a 30-second speed round, but something approximate to that. MPLX deal, pretty big news. So can you walk me through what that means for Mara? Tell me a little bit more about the LOI. As I understand it, I don't know if it's a non-binding or binding LOI. My first look at it was a non-binding LOI. I'm curious, like, what does the progression of that deal look like in terms of stages for closing and then getting the first 400 megawatts off the ground?
As we said in the press release, we're expecting to finalize the final agreements over the next 90 days, which will be, at that point, fully binding in all aspects. They're basically 3 locations that we're looking at. You can think of it as MPLX is a large provider of gas refining services, and they operate gas refining locations in a number of places. Initially, we're focused on a series of locations in Texas, predominantly. And the goal is Mara gets access to economically priced gas. Mara will build energy generation capacity, leveraging that gas to supply MPLX with power, because MPLX has a need for power, to power data centers that Mara builds, operates, and or offers as co-location facilities and or whatever on that side, and also be able to potentially sell power into the grid, TBD on that side. What does it take for us to get there? There's a series of permitting around the generation stations, just supply chain components to that, and then it's build and operate. If you look at the team we have been building over the course of this year, we have been hiring people out of the energy industry itself, people who have experience in owning, operating these types of energy assets, who have done it across multiple energy utilities over years, people who know how to originate these types of deals and execute them. Mara is not going to be the EPC company. There are lots of great EPC companies that build these things, but we have been putting in place the pieces to be able to do this over the course of this year. So the goal is that we will have 3 sites, initially around 400 megawatts, with the ability to grow to 1.5 gigawatts. And those will have the opportunity to be whatever we want them to be. So we have that optionality and flexibility. Most likely the power gen won't come on stream until 2027 because it just takes that much time to build these sites. But that also gives us time to go out and capture the revenue generation we're going to do from it. And so that's super exciting. And this is it's obviously an important deal for MPLX, because otherwise they wouldn't have been eager to announce it when they wanted to. And I think you're going to see more and more companies that own energy assets, raw energy assets, if you would, midstream, et cetera, upstream, becoming more and more interested in having this type of optionality so that you can build true behind the meter type of operations. So if you think about the economics of this longer term, it's super attractive longer term. And it's an asset that will, keep generating very nice returns, whether we operate data centers on it or not. So,
is there any expectation for near-term costs in order to build that out? Expect on maybe the generation side once it gets going? And can you speak to a little bit of those generation costs?
The CapEx cost, obviously you have to fund the build out. A portion of that will be done through, a large portion of that will be done through project finance, because these types of assets can be underwritten that way. And then the balance will be done off on the balance sheet or leveraging just additional debt.
Gotcha. Okay. No, it's an exciting opportunity. Any thoughts on like the Texas market for finding new energy assets? My understanding is that the queue there is pretty long. A lot of people, ERCOT's even changing the rules, right? Where it's like, hey, we have so many people signed up to the same slot for energy that they're forcing some rule changes to make it a little speedier and more transparent on who gets signed. Do you think that this venture is it like the next iteration of what these deals are going to look like because of congestion in the Texas queue? Or is it sort of, I'll let you actually take it anywhere, because I don't want to just give it like a binary, one or two options. But I'm curious, like this deal was significantly different than a lot of the other ones that we've seen. So I'm curious, like, why did this structure come up as an organic thing because of how the Texas grid is working currently? Or was there something else that I perhaps want to know about for why it was constructed this way?
Yeah. So again, we made a very concerted effort to hire people out of the energy generation industry, because if you believe that electrons are the new oil, then you want to own the oil well, right? And you want to own what you do with that refined oil, right? If you think about what was a big issue for the Saudis 10, 15, starting 20 years ago, was how do we not just sell oil? How do we actually sell plastic? How do we sell fertilizer? What do we need to do to maximize the value of the whole stack, right? And so as we looked at energy, we said, you as long as you are paying a PPA, you are a slave to an energy generator, right? And so do you want to be that? Because that forces you into doing deals that are profitable because you have a floor cost of your energy. So if you instead can be the energy generator, you have a lot more optionality, right? For one thing, you can choose to generate or not. You can sell energy, you can consume it yourself. And if you're doing it behind the meter, you don't have queues, you don't have transmission costs, you have all sorts of benefits.
Gotcha.
Right? And then, so you have maximum optionality, and our need for energy is not going to disappear, right? We are going through, regardless of the current political climate, we are moving to a world that is more and more electrified, electric vehicles, et cetera. I also think we are moving to a world where the nature of what grids are changes. I think and this is over a much longer period of time, we will see much more microgrid development happen, right? Where you generate energy in or near the location where it's consumed to avoid transmission issues. Because the biggest issue, whether it's Texas or the rest of the world, and the same thing exists everywhere globally, is transmission. It's expensive, and it's an arcane issue that you have to send electricity in wires. Just go back to the telecom industry, right? When China was building out its telecommunications infrastructure, they went straight to wireless, right? And it allowed them to build more. I am very optimistic that we will have, within the next 10 years, the ability to transmit power over short distances wirelessly. But what that means is that you're going to want to have microgrid technology. I also think that PV technology is going to get to the point where in certain parts of the world, you will be able to generate electricity simply by cladding a building in a particular film. And then you have batteries, and then you become an energy generator for the buildings around you. And you run a data center in the basement of that building, which heats the building with the heat reuse, and then also acts as the localized compute. And then network transmission starts becoming a bottleneck. And that also is moving quickly to wireless. You see some of the stuff Google has done with transmitting 20 gigabits per second over 20 kilometers using lasers, stuff like that. Very interesting technologies. The world is going to satellite and low orbit. Satellite, the minute you remove network latency as an issue, you can put AI wherever you want to. And then guess what? Owning all those electrons in faraway places becomes really attractive. Mm-hmm. And look at what Saudi, when I was at FII 2 weeks ago, one of the key announcements by Saudi was essentially they are going to fund and build data centers that provide self-sovereignty over portions of those data centers, because they have now solved the network latency issue. And this was something the executive team at Humane was talking about at the conference. You can now be a company in the UK and effectively operate your AI in Saudi at very low latency potentially. And so what does that do? It goes back to what is the core cost of all this, and its power, and who owns the energy generation? Can you build data centers at the site where energy is generated, obviating the need for transmission, such that your only bottleneck is network latency, which will be solved through wireless means shortly.
And so from a balance sheet perspective, you're very comfortable with Mara being long energy from a balance sheet for everything you're doing. So two more questions, or three more questions rather, two not so fun ones, one fun one. We did some reporting here at Blockspace about Ashu, the CTO, being taken off the company website. Curious what happened with that. Also, the two-pick solution was ended. Is there any comment that you can give on the changes with two-pick, and then more generally, why the CTO position was removed from Mara?
Well, we don't comment on personnel changes.
Okay.
So I'm not going to comment on that. Regarding two-pick, what we have ended is two-phase immersion technology for the moment. The reason being, as I said on the earnings call, is when you talk to large data center operators, they don't want to immerse anything in fluid. They want to use direct-to-chip cooling, which will work for another 2 generations. So you're looking at 2 to 3 years. And for us to keep funding two-pick at the level we were funding it, if we're not going to realize revenues from it really for 2 to 3 years, it just didn't make sense, because the technology will change dramatically between now and then. But that doesn't mean that we're not still developing cooling technology. It doesn't mean that we're still not looking at two-phase technologies. You can see we filed a number of patents around the space, and we'll continue to be active. But the efforts we were doing around it have been curtailed.
And so just to reiterate what you're saying so I can understand it completely, 2 to 3 years out from getting to a two-phase immersion solution as being something that people are interested in again, or in the short term, you don't see the realized revenue, and so you don't know what's going to happen in a few years for the cooling side, and might as well just sunset for now.
So the CPU, GPU, ASIC vendors don't want to worry about warranty risk related to immersion, because it puts a huge onus on the system vendor who builds the underlying system, meaning the compute system vendor. That they use the right pastes, et cetera, et cetera. So there's a whole series of issues. And so you essentially void the warranty when you put it in fluid. At the same time, if you have a new Apple iPhone 17, they talk about vapor cooling. That is two-phase liquid on chip cooling.
Gotcha. Interesting. Okay.
So that technology, we believe, is going to become economically viable at the data center level, which gets you another generation or two beyond where current cooling technologies get you. And, like with all things, we are still running, the vast majority of the internet still runs on TCP/IPv4, which is arguably ancient. And so if you have an evolutionary technology that is good enough, you don't have to go to revolutionary technologies until you absolutely have to. And so I believe what you'll see is two-phase vapor technologies becoming much more prevalent in liquid cooling and much more commoditized. And so that then potentially becomes less interesting and less of a unique competitive advantage, right? Because we're not trying to put Vertiv out of business, right? Our whole reason for 2PIC was to have a technology that allowed us to have a technology moat and a leg up in that we could run stuff with a much lower PUE, right? And so as the ability to have that advantage decreases, then you're better off buying stuff off the shelf. So it's kind of like, go back to the old days of the first PCs. IBM built the first IBM PC as the first product built with third-party pieces, where before they were fully vertically integrated. And I think data centers, are definitely third-party best-of-breed solutions. We don't believe it's our place to have to be the best-in-breed cooling technology, because that's going to commoditize quickly. And I think, generally speaking, data center hardware technology is going to commoditize very quickly. And all the value will end up on the software stack. And again, that's why we're focused on that end of it and not on the hardware side.
Nice. I like that we kind of came back to the Exaion deal there. One more question. So on Friday, I believe it was the 7th, you guys announced that going forward, you intend on using the Bitcoin stack, either through, I assume, sales of a monthly production or perhaps even sales of the treasury to fund operations. And you're going to, quote, limit reliance on our ATM to support growth. Can you comment on the share growth over the last year? Looking at the numbers, it went from under 300 million to over 400 million in about a year. How did you guys position that equity, capitalizing on that equity to grow the company over the last year? And then why the change up into using the Bitcoin mining operations into fund further growth? And I can re-clarify that question if it's helpful. But
here's a simple way to look at it. If you compare over the past 5 years, the amount of dilution we have done to our shareholders versus TeraWulf or a number of others, we're at the very low end of the curve when you look at that. And, you can talk to our IR folks to get the exact numbers. The other thing you can look at is our return on capital deployed has been much higher than a lot of people. So it hasn't been dilutive in that way. The reason for the shift in the Bitcoin, and this is something we actually signaled in the prior quarter, where we said, we may from time to time decide to sell Bitcoin to fund operations. We've now just been a little bit more adamant about it, because we believe that the volatility, and this gets kind of back to a broader topic of, Bitcoin price and where's it going, right? If Bitcoin price is running, right, and by that I mean 30 to 50% increase per year, it makes sense for us to hodl everything we can, and to because our cost of capital is lower using equity or debt than it is selling Bitcoin. And it makes sense for us to buy Bitcoin versus mine Bitcoin.
Yeah.
So if you go back to last year, right, October 2nd of last year, Bitcoin was at 60K, right? And what were we doing that time last year? We were busy buying all the Bitcoin we could.
Mm-hmm. Mm-hmm. Yeah.
Fast forward to today, Bitcoin has hit an all-time high of 30 or so days ago. It is sitting in a likely sideways pattern for a while. And so now it makes sense to, as opposed to acquiring more Bitcoin, taking some profits from Bitcoin, using those to fund operations, to grow operations. And then as the average weighted cost of capital shifts, we'll adjust that position, right? So this is really just a looking at financing and how it affects our cost of capital. I personally, believe Bitcoin will continue to go up in price. I think if you look at some of the recent estimates, people have said they have all brought their estimates down. And if you remember what I said on our Q2 earnings call, I said the market is frothy, right?
Yeah.
Which it was. And here we are at, we're about 20% off the peak, right?
Yeah.
So I think, as you look at our large Bitcoin hoard, then, this is something we're beginning to actively manage more and more. And we believe there are opportunities around taking a small portion of it and trading it to generate enhanced yields. And then at the same time, we have existing operations that we do where we lend out Bitcoin, et cetera, to generate yield.
So in terms of the capital stack, for Bitcoin miners traditionally, and increasingly all these companies are not Bitcoin miners, but multiple plays. You had mine Bitcoin, sell Bitcoin, you had dilute shareholders with equity, and then you had debt financing agreements. And it seems from our conversation, debt will be used pretty heavily for building out CapEx for energy solutions with project financing, which is fairly typical. Turning off the equity switch for now because it's becoming too expensive in a market that isn't valuing Bitcoin miners certainly right now very highly. And then you've shuffled into the top stack, selling Bitcoin on a go forward basis, depending on market constraints. For 2027 or 2026, rather, not to jump 2 years ahead, 2026. Any outlook on Bitcoin price? Got to ask that one question, right?
Well, just want to correct one thing. We're not shutting off the use of the ATM. We're just decreasing it, right? Because again, for growth equity purposes, so there's a difference between diluting shareholders to fund operations on an OpEx perspective or doing it on a CapEx perspective, right?
Okay.
CapEx, it's still a very accretive cost of capital, right?
Gotcha. Yeah.
Because you're using it to invest in something that generates revenues and value. From an OpEx perspective, today we're better off selling Bitcoin. So just to clarify that piece.
No, that's helpful. Thank you.
It's not an absolute, right?
Yeah, definitely.
As you look at 2026, I think Bitcoin is no longer in a 4-year cycle. I think everybody is slowly but surely gotten to that point. It has become very institutionalized. And because of that, the flows of Bitcoin have changed a bit. But Bitcoin has grown to a point where, and I think Jordi Visser does this great job of kind of the analogy of Bitcoin going through an IPO. I don't know if you've heard this, but basically as Bitcoin goes through an IPO, the early investors sell out and the institutional investors start coming in. And you now have a period where it's now able for a whale who has $10 billion of Bitcoin to go liquidate $1 billion of Bitcoin and it not having a huge impact on the price of the market. Yeah. And so what you've seen is some whales turn some of their hodl into wealth that they can use for diversification purposes, estate planning purposes, whatever the reason may be. And you're also starting to see, with the worry of quantum, people starting to move Bitcoin from legacy wallets and do two things. One is with the contribution in kind with the ETPs, you can now take Bitcoin, contribute it to an ETP in a very tax efficient manner. And now you don't have to worry about custody. Yeah. Right. Because I think people's single biggest fear today is, either through self-inflicted issues of somebody forgetting a password, dying, whatever, not sharing the hardware wallet, whatever, or hacks. People are really worried about that. And then especially for the 6 point whatever million Bitcoin that are still in these original wallets, you really need to move those into newer generation custody solutions. If you're in your self-custody, at least move it into a new type of wallet. So you've seen this kind of churn of Bitcoin ownership. And what that does is it creates a new foundation. So I think we're going through that process, and a lot of that liquidity has been soaked up by institutional investors, which has been great to see. Then you have a correlation to money supply, and yes, money printer go whir is going on. But you also have the economy starting to maybe bend itself down towards continued inflation. You're going to see job-related issues, and cost of living is becoming an issue. And so what happens is, 25% of equity investment happens to come from retail. You're going to see retail reaping the benefits of all these AI profits they've generated, and Bitcoin starting to pull money back and pull their risk tolerance back. And what that does is sucks the air out of the Bitcoin market.
Yeah.
And so I'm not predicting in any way, don't get me wrong, I'm not predicting a huge downturn, but I am saying that I think the continual demand, that vacuum cleaner that's constantly sucking up all the Bitcoin, has way turned down the volume.
Yeah.
And so now we're in a market which is going to be more susceptible to things like this whale that went and put that huge perp short out, and did things like that. You're going to see a market that is a little bit more fragile.
Yeah.
And so I think that you can't count on dips being bought and things like that. And as the government, gets through doing things like, funding itself and, God forbid, becoming functional, we will, we'll see, Bitcoin continue to, build on the base that it has. And, longer term, Bitcoin's going to continue to appreciate at a very attractive rate. It's a top 10 asset class. But, let's be realistic. A 10% change in the price of Bitcoin is a $200 billion increase, right, in the asset. That's a big, right, because it's a finite asset, right? I mean, it's not like oil. You just pump more of it. Right. So people have to realize that, the law of big numbers is going to work against us a little bit here, and that the numbers are getting so big that, 60% price bump in a year, you're talking over $1 trillion of capital coming to Bitcoin. Just to support a price like that. So I think, it's maturing as an asset class, which is great. You're starting to see all these really positive things happening in the TradFi world. And meanwhile, in the developing world, you're continuing to see Bitcoin playing a more and more active role in these economies and for these countries. And I think, longer term, vast majority of wealth advisors, a lot of capital will be allocated to Bitcoin as a store of value. And you'll see it as a reserve. More companies are putting it on their balance sheet as a reserve. And I think that the next 4 to 5 years are going to be great for Bitcoin. I just don't see a short-term road to $1 million Bitcoin. I think it's going to be a lot harder than most people think, because I don't think the world we are going into over the next 4 or 5 years is one that is conducive to huge amount of risk on.
Well, last question for you. Are you a reader? And if you are, what's a book you've been reading recently that you're enjoying? I know you're on planes quite a bit.
One of the favorite books currently is The 4 Disciplines of Execution, which is all about, it's a management leadership book, which is really good. I think that we as leaders all have to constantly sharpen our swords and figure out how do we become better at executing. When you look at Mara, we are still 250 or so souls only. And so, we are constantly optimizing kind of our team to make sure that we have the right people in the right seats doing the right things. And that basically forces a certain amount of reinvention every now and again, which I think is really important, because if you don't do it, you have problems. And, a number of our peers have done similarly. Look at CleanSpark did something like that recently too. So it's really important for companies to go through and do that. But execution is critical. And then just on the personal side, I love to sail. So I've been reading a lot of global circumnavigation stuff. So that's a hobby down the road. So
I love that. That's awesome. Well, Fred, thank you so much for joining the Mining Pod. It's been too long since you came on, but we got a really full interview. Appreciate all the insights into what Mara's doing. And best of luck as you go into the rest of the year, and happy holidays. So thanks for your time.
Great. Thank you very much. Great to speak to you, and happy holidays to you too.